Many people took advantage of the historic low interest rates we saw during the pandemic. But what many Canadians are running into is their renewal rate is going to be much higher than the rate they have locked in, leading to some payment shock because of such increased mortgage payments. This is leaving many Canadians concerned with what rate they're going to be offered at renewal and what their payment is going to be, overall worrying what their financial situation is going to be like. Before we get in this video, I ask if you can like, subscribe, and share this video with a family member or friend, as will help grow my channel and reach more Canadians who are also looking to learn about the mortgage and real estate industry. In this video, we're going to be looking at your options when renewing your mortgage. Because yes, the people who locked into the historic low rates we saw during the pandemic are going to be in for some payment shock when they renew. Here's a quick example of someone renewing into a higher renewal rate will be impacted. So based on a $355,000 mortgage amount, let's say you locked into a rate of 2.49 during the pandemic. That means your monthly payment would be $1,605. Now let's say your term is up and you need to renew and you're getting offered rates of around 5.25. That will make your payment $1,800. So that's $200 more and a much higher rate. With the cost of living in Canada being so high right now, it's getting harder for some Canadians to absorb this increased mortgage cost. Not to mention, this is based off a $355,000 mortgage amount, whereas we have seen, especially people who locked in over the pandemic and bought a new house, their mortgage amounts will be much, much higher because of the high home prices we saw during the pandemic. So a higher mortgage amount would just amplify that increased cost. Now, what are your options at renewal? Well, first off, you could just renew with your same lender. They're gonna send you a renewal rate, and the benefit to this is you don't have to requalify. As long as you've been consistently making your mortgage payments, your bank will offer you a new renewal rate. So if you're not happy with the renewal rate they're offering you, or you don't think you're going to be able to afford this higher monthly payment, you could shop around your mortgage. When shopping around your mortgage, there are two routes you can take. We can either explore transferring your mortgage or refinancing your mortgage as a whole. If you're looking just to shop around for the best rate on the market and you're not looking to access any equity in your home, then that would just be doing a transfer. You do have to still requalify when doing a transfer or switch, so keep that in mind. Now, the second route is doing a full refinance. This is where you get a whole new mortgage for a larger amount for the desired equity you want to access, and then pay off your old mortgage. Unlike with a switch or transfer where you can't access the equity in your home, with a full refinance you can. Now, the other benefit I want to mention about doing a refinance is that you can actually re-amortize your mortgage up to 30 years. So those who are worried about not being able to afford their mortgage payment, this could be a solution for you because we're stretching out your mortgage balance over a longer period of time, meaning your mortgage payments are going to go down. Here's a quick example of a $300,000 mortgage balance with your current rate being 2.5% and the bank is offering you a 5-year fixed rate of, let's say, 5%. Let's say you have 15 years left in your mortgage's amortization. Your payment would be $2,364. Now, if you were tight on cash flow and wanted to re-amortize your mortgage to give you more monthly cash flow, we could stretch that amortization from 15 years back up to 30 years. And let's say, for example, you accessed $70,000 of equity in your home. Now, since you are refinancing, your mortgage would be classified as uninsurable, so you'd be getting offered uninsurable rates, which are higher than insured or insurable, but you would get that much needed cash flow that you're looking for. So here's what it'd look like. With your new mortgage balance being $370,000, an extra $70,000 in equity, the uninsurable rates you'd be offered would be around 5.24%. So your monthly mortgage payment would be $2,027. So even though you have a higher mortgage balance and have a higher interest rate, we stretch that mortgage amortization up to 30 years and your mortgage payment would be approximately $300 less monthly. Now, over the life of your mortgage, yes, you would be paying more towards interest because you're taking longer to pay it off. But if your current situation is in need of financial relief, then this is a solution for you. And keep in mind, let's say, for example, when rates go down or inflation comes down and you have more spending money, you can always utilize your prepayment privileges to decrease that amortization, saving you on interest. So for those of you who are concerned about their financial situation coming up for renewal, just know there are options for you. You just have to talk to the right people to understand what options you have. So if you'd like to discuss your options, I have my calendar link below. Go fill out a time slot and I'll be happy to discuss what options are available to you. Don't forget, I have those 3 free mortgage guides: the first time homebuyers guide, the refinancing guide, and you found your dream home. Now you need to obtain financing. Those are in the link description below. They're free. Definitely go check those out. And if you found value in this video, please like, subscribe, and share with a family member or friend who'd also enjoy seeing it.